$4.37. That was the number. First quarter, first dividend deposit. I almost deleted the notification. The way you swipe away a weather alert on your phone without reading it. $4.37 on a $31 share after 3 months of holding it. Most people would look at that number and think it does not matter. Most people would be wrong. Not because $4.37 is a lot of money, it is not. But because $4.37 is a system announcing itself. A system that left alone for long enough turns into $700 a month. There are 5 rules, not suggestions rules. I ran the numbers on all 5 they hold. By the end of this, you will know exactly what those 5 rules are, and exactly how they turn $500 a month into a system that deposits $700 into your account every 30 days, without you showing up to work. That $4.37 is a seed that looks like nothing. A seed that you could step over every day for a year and not notice. But it has a root system, and root systems do not care whether you believe in them. Rule 1. If the yield is above 6%, something is wrong. This sounds backward. Higher yield means more money, right? That is what it looks like on your Fidelity app. That is not what it is. A high yield usually means the stock price collapsed and the dividend has not been cut yet. The word is yet. Dow, the chemical company, not the index. In 2025, the stock yielded above 10% at 1.10% yield. Looks incredible on a screener. Then they cut the dividend in half. Stock dropped nearly 37% in the same year. The people who bought for the 10% lost the 10% and lost 37% of what they put in. 3M's 67 years of consecutive dividend increases. 67. Then a 40% cut in 2024. Walgreens almost 50 years of growing its payout. Dividend aristocrat. Then the payout ratio hit nearly 300%. They were paying out roughly $3 for every $1 they earned. And they slashed it. $4.37 does not look exciting. That is the point. $4.37 on a stock yielding 3.37% means the company is not bleeding to give you that payment. It can sustain it. The boring deposit is the safe deposit. The number you actually want from a dividend investment is not the yield, not the current yield. Rule 2. Dividend growth rate matters more than current yield. This is where the math gets quiet and important. A fund yielding 3.5% that grows its dividend by 10% a year will pay you more in year 8 than a fund yielding 7% with zero growth. I built the spreadsheet, checked it twice. SCHD, that is the Schwab US Dividend Equity ETF, one of the largest dividend-focused funds on the market. $88.8 billion in assets. Expense ratio of 0.06%, which means you pay 60 cents a year for every $1,000 invested. Its Q1 2026 dividend came in at 25.69 cents per share, 3.3% higher than Q1 last year. 3.3% growth does not make you feel anything. But the 10-year annualized total return on that fund, dividends reinvested, is 12.57%. The yield did not do that alone. The growth did. The numbers here are publicly available. This is education, not a recommendation for any specific fund or allocation. And your situation has variables I cannot see. But the math structure works the same way across dividend growth investments. Confirmed. The thing most people get wrong is they shop for yield. The way they shop for gas prices at the Costco pump. Cheapest number wins. Dividend investing is the opposite. The boring number wins. Rule 3. Turn on DRIP and do not touch it. DRIP Dividend Reinvestment Plan. Every dividend payment automatically buys more shares. Those new shares earn dividends. Those dividends buy more shares. Most brokerages have a toggle for it. On Schwab, it is a checkbox. On Fidelity, it is under account settings. It takes about 45 seconds. That 45 seconds changes the entire math. Here is where I need a person. Someone 30 years old, logistics coordinator in Raleigh, $68,000 a year before taxes, has a 401k through work with about 40,000 in it. Right around the median for that age group according to Vanguard's data. Never bought a dividend ETF, never thought about it. Has a high-yield savings account earning about 4%, which used to be 5% before the rate cut started. The Fed held rates at 3.5 to 3.75% in March. The dot plot projects at least one more cut this year. Every cut means that HISA number drops. It was 5, it is 4. It might be 3.7 by December. That number only goes one direction from here. Meanwhile, the 437 does not care what the Fed does. The companies in that fund set their own payout schedules. This person opens a brokerage account, puts in $500 a month, buys shares of a broad dividend-focused ETF yielding around 3.5%, turns on drip. Year 1, $6,000 invested. Her dividend income for the year is about $210, $1,750 a month. That is the 437 phase. Quarterly deposits that look like rounding errors. They do not stop. Year 5, $30,000 in, but the shares from year 1 appreciated. And the reinvested dividends bought more shares, and those shares earned dividends. The account is not $30,000, it is closer to $38,000. Annual dividend income around $1,300. Still not life-changing. That is real. Year 10, $60,000 invested. Account value north of $95,000. Annual dividend income around $3,300, $275 a month. Something happened in there. Between year 5 and year 10, the seed is still the same seed, 437, but it has been splitting underground for 10 years quietly. While this person was going to work in Raleigh, not checking the account, not thinking about it at the Starbucks drive-thru on the way to the warehouse. The roots were spreading. Year 15, $90,000 invested. Account value around $170,000. Annual dividend income crossing $5,420 a month. Year 20. $120,000 invested out of pocket over 20 years. Account value approximately $240,000. Annual dividend income around $8,400. $700 a month in dividend income, not touching the principal. The principal is still there, still growing, still compounding. The root system took 20 years to build. The tree is paying $700 a month and nobody had to water it since year 1. $700 a month does not replace a salary, but it replaces a car payment or the grocery bill, or the gap between Social Security and what a person actually needs in a month. Rule 4. Know the tax difference, qualified versus ordinary. This is the rule most people skip. It costs them. Qualified dividends, the ones from stocks held at least 61 days. Around the ex-dividend date, get taxed at capital gains rates. For a single filer making under $49,450 in 2026, the qualified dividend tax rate is 0%. You keep every cent. For the logistics coordinator in Raleigh at $68,000, the qualified rate is 15%. Non-qualified dividends, REITs, certain foreign dividends, shares held under the minimum period, taxed as ordinary income. Same person, 22% bracket. 15 versus 22. On $8,400 of annual dividend income. That is $1,260 in taxes versus $1,848. A difference of $588 every year, not once. Every year. And that $588 compounds too, because it stays invested instead of going to the IRS. You would see that number on your return if you use TurboTax or sit down with someone at HIR Block. It shows up on Schedule B, line by line, $588. Not a typo. Most of what SCHD pays is qualified. Not all dividend funds work that way. Check before you buy. IRS publication 550 has the holding period rules, the ex-dividend date math, all of it. That is not a detail. That is $588 a year you keep or give away based on one checkbox. What is your current dividend income taxed as, qualified or ordinary? If you do not know, pull your last 1099 div. Box 1A is total ordinary dividends. Box 1B is the qualified portion. The gap between those two numbers is what this rule is about. The other route, hold dividend investments inside a Roth IRA. Dividends grow tax-free 0. If this person maxes out a Roth at $7,000 a year and fills it with dividend investments, that $700 a month in year 20 comes with no tax liability at all. Rule 5. Do not put more than 30% of your portfolio in dividends. This is the rule that dividend investors do not want to hear. Dividend stocks are stocks. They go down. They correlate with interest rates and sector rotation. A portfolio that is 90% dividend ETFs is not diversified. It is a bet on one factor. The logistics coordinator in Raleigh, 40,000 in a 401k, 500 a month going into a dividend-focused brokerage account. If this person follows the plan for 10 years, the dividend account is around 95,000. The 401k, assuming 7% average returns, is around 130,000. Total retirement assets around 225,000. Dividend portion is 42%. Too high. 30% is the ceiling I keep coming back to when I run these models. Above that, one bad year in dividend-heavy sectors, energy, utilities, financials, real estate, and the whole retirement picture takes a hit that a growth index or a bond allocation would have cushioned. I run these numbers regularly, more than I probably should. The fifth rule is the discipline rule. Keep the system running, but do not let the system become the whole thing. Now 5 rules, because I need you to have them. Yield above 6% is a warning, not an invitation. Growth rate beats current yield over time, drip stays on. Qualified dividends save you $588 a year on $8,400 in income. 30% ceiling on your total portfolio. If you want to go deeper, the Schwab website has the complete SCHD holdings list and full dividend history going back to 2011. Publicly available, no account needed. And IRS publication 550 lays out every qualified dividend rule. Holding periods, ex-dividend date windows, the 61-day math. Those two will answer most of what comes next. There is a 6th question I did not get to. What happens when you start picking individual dividend stocks instead of an ETF? The math on that is different. The risk profile is different. The numbers are more interesting and more dangerous. That $4 seed is still sitting there in a brokerage account in Raleigh, on a phone that gets a notification every quarter. The notification is getting larger slowly, the way roots move through soil. You do not see it happening until one morning the number is 700, and you did not do anything that month to earn it. $8,400 a year, $700 a month, from $500 a month and 20 years of not touching it. I checked, that number is correct.